Why did 1,500 strangers spend a year sitting in Chinese coffee shops counting cups? It looked like market research. It was not. It was an investigation into Luckin coffee, and it worked. Almost half the coffee the company sold in 2019 had never existed. The cups were never poured. The money never came in. Luckin was opening stores in China faster than Starbucks, and nobody had caught it. But the people who did catch it had a problem. They were not regulators. They had no legal authority of any kind. They were investors who believed the company was lying about how much coffee it sold. So they hired 1,510 people to sit in Luckin coffee shops and count. 620 locations, 11,200 hours of video. Nobody serving coffee in those shops knew they were being counted. In the last 3 months of 2019, Luckin reported 88% more items per store than it actually sold. But the counting was the easy part. What sat underneath it was stranger. Luckin opened its first store in Beijing in October 2017. Less than 2 years later, it was listed on the Nasdaq in New York. That is faster than almost any company in modern history. On the 17th of May 2019, it sold 33 million shares at $17 each. The market valued it at $4.2 billion. By January, the shares were trading at $50. The idea behind it was simple enough to explain in one sentence. China drank tea, so a company that taught China to drink coffee would own an entire country's habit. There were no cashiers. You ordered on your phone and collected a cup from a small counter. The stores were tiny, the coffee was cheap, and the discounts never stopped. Everything about it grew, and the numbers on the filings grew faster. Then a report appeared online with nobody's name on it. It was the 31st of January 2020. 89 pages, no author. The counting operation was inside it, hour by hour and receipt by receipt. Luckin denied everything and called the report misleading. For 2 months, nothing happened, and the shares held. Then on the 2nd of April, the company investigated itself and admitted it. Between April 2019 and January 2020, it had invented more than $300 million of sales. The transactions were routed through companies connected to its own people. The coffee was never made, and the customers were never there. Here, the story stops being an ordinary accounting scandal. Fake revenue creates a problem that most people never think about. If $300 million arrives that nobody paid, the money has to go somewhere. A company that sells $300 million of coffee has to buy $300 million of cups, milk, and beans. Otherwise, the accounts show a business with enormous sales and almost no costs. So they invented the costs as well. More than $190 million of expenses were added that never happened. Fake purchases were made from suppliers to balance fake sales to customers. Each lie required a second lie underneath it to stay upright. And the third layer is the one regulators found hardest to describe. Luckin built a separate operational database. It held order records for coffee that had never been ordered. Bank records and accounting entries were altered to agree with it. By the end, there were 2 companies. One sold coffee in China, the other existed in a database and sold nothing at all. Auditor investors and regulators were reading the second one. What happened next was fast and public. The shares lost most of their value within days. On the 29th of June 2020, the Nasdaq removed the company. In December, it agreed to pay the American regulator $180 million. It settled without admitting or denying anything, which is how these agreements usually work. The chairman resigned. 2 of its most senior executives were banned for life from running a listed company in China. Every part of the punishment landed exactly where it was aimed. This is the point where the story is supposed to end. It does not. In 2023, Luckin took more money in China than Starbucks did. By the end of 2025, it had almost 31,000 stores in the country. Starbucks had a little over 8,000. In February 2026, it opened its 30,000th store worldwide. It reached that number 6 times faster than Starbucks had. By the 31st of May, it had passed 35,000. 5,000 of those opened in about 3 months. It now sells coffee in New York, in the city whose exchange threw it out. And here's the part almost nobody says out loud. The reason is uncomfortable, and it explains why the punishment changed so little. The fraud was in the paperwork. The company underneath it was real. The stores existed. The app worked. The cheap coffee sold. What was faked was the speed, not the business. Regulators can delist a share and ban a director from a boardroom. They cannot close 30,000 shops that people actually walk into. The market punished the shareholders, and the shareholders were mostly foreign. The customers were never asked and never left. The fine was $180 million. The company is worth billions again, and it is still expanding. Somewhere near you, a business is being valued on numbers nobody has counted, and almost nobody is sitting in the shop with a camera.